Once it's in Camtasia, I can trim off all this fat because it hasn't started yet. I'm going to have perfect 1080 clarity. And I can even produce it at 60 frames too, just like they did. But where the fuck is it going to start? Hello, traders. This is Gary Wagner, and we will be starting momentarily. Please make sure that you've got your volume to hear me speak, as well as tuned in to the show itself. Again, hello traders. What a day we have seen in the marketplace. We had a pretty intense sell-off in the precious metals across the board. And today what I'm looking to accomplish is to give you my overview on all four precious metals, look at some short-term charts, some longer-term charts, and try to answer the most important question, which is where the markets are going to go from here. Obviously, we did pull profits today on our trade. If you recall, we raised our stop yesterday to 1330 and change. The market is currently trading at 1326.60, so well below our exit price. And I believe that we got in at around 1316. So we had a pretty decent profit on there. On the screen that we are looking at, what you are seeing is a 720-minute chart. So each candle, simply put, represents a half a day of trading. And we can see the severity or just how much this market moved down, and it was pretty intense in terms of a day. Interestingly enough, it was silver that had the greatest drawdown, and we'll talk about that as we pull up our technical studies. And so the chart that we're looking at has a couple of really interesting features. Of course, we have our moving averages in, but what I want to draw your attention to is two things. The first thing is our current Elliott wave count, short-term count, because we are using 720-minute charts. And then the second thing is going to be our fib retracement areas and our projections for where this market could trade to if we actually have this market continue to sell off. As I go through the analysis, you can type your questions in, and then once I go through the basic analysis with the charts, I will go through and try to answer all your questions, as many as I can. So first of all, welcome to our first live event. I hope that it has some meaning for you, and more importantly, it gives us a chance to interact, and that to me is what's so critically important. And so based on that, let me show you what I'm looking at. As we look at this chart, what you will see is you've got the conclusion of a wave one here, then down here at around these lows just below 1200, a wave two, and then this long move from about 1200 up to the top of 1350 is a wave three. That's the longest of all of the impulse waves, and when we consider the extension from wave one to wave three, it actually is just shy of 2.618, which is the most aggressive of that type of a move up. Typically, you can see it go to a 1.618 extension, but when you get a 2.618 extension, that's a sizable rally. We're talking about something that moved $150. And so we really get an indication that on a short-term basis, we have hit a top. The projections based on the Elliott wave count are coming in different areas. The lowest is coming in at around 1293, and then an extremely low one, that's these red lines here, would come in a little bit lower. And so with that in mind, I want to actually go ahead and pull up our daily chart, which is going to be the one that we use the most of, because daily is really where I look at for my long-term market analysis. The first thing I want to say is, as you know, we've been talking about some projections that we did, and initially my projection for the top of this was about 1338. This is a 1.68 extension of a shorter move, and then the 1.38 extension came in at 1319. We absolutely did top out at 1350. That was just yesterday, and today we had this dramatic sell-off. The first level, of course, that we would want to watch is 1323. The market is now at 1326. So we're just shy of that. And then these middle ones right here, starting at 1350 with zero down to these lows, this represents the entire rally itself, and 1308 becomes a critical number. And so what I'm looking for is as follows. We got in at 16, we got out at 30, we pulled profits. The market is now lower than we are. We're sitting flat with no active trades, and we're looking for a proper point to enter. My sense is I have been waiting for some sort of a correction. Correction after a $150 move is healthy, and it is to be expected. And I would be surprised if we don't see a little bit more downside movement in the marketplace in terms of a correction. So the areas that we're going to want to look at are really around 1300 and 1308 on the low side. On the high side, it's just right in this area. However, we have had so many shallow retracements, I would be quite surprised if we don't get something that is a little bit deeper. Now, the key to this market right now is how low it will go before it corrects. I mean, the correction is over, excuse me. And my low number would be around 1300, and that is to 1294, which is where our 50-day moving average is. And so I wanted to answer some of the questions as they come in on gold. And this comes in from Elliot C., and he's asking, where is gold going from here? Consolidation or more correction? My sense is that with this kind of a large move today, it's more likely a correction than a consolidation. But realize this market is based on fundamentals and not technicals. And if we have events that spark this back up, we could see it be another shallow retracement. However, based on today's action, I do believe that we're witnessing the beginning of a correction, and there is more room to the downside. The next question that I'm going to read is that we know that gold was overbought, but a 1.5 decline with most of the news today is sounding positive for gold. I agree with that fully. I think that what we're witnessing in terms of today's sell-off is absolutely a technically based correction. It is really not based on a major shift or change in the fundamentals in the market. And so I would have to agree with both of you. If there's any other questions with gold, we'll go ahead and answer those. If not, we'll go ahead and take a look at our next market. And so with that in mind, I want to take a look at what silver's doing. And all of the markets that I'm looking at, silver is the one that I am least bullish about, and I'll show you why. I'm going to really have to go in ahead and compress it. When we do, we can see that we have these tops up here at around $21. And from that point, and we're looking really mid-2016, we have seen a slow and methodical decline till we hit these lows at approximately 14. Now, with that in mind, we can go ahead and re-enlarge that. You can see that in terms of major support, I would put that at around 1527. Major resistance at about 1650. It's between these two marks. But I am not confident that gold is going to move in tandem with silver in terms of the different percentage gains or drawdowns. I think that gold will definitely outperform silver overall for at least the next couple of months. Now, the one market that has been extremely bearish and has been so surprising, of course, has been platinum. And you can really see that once again if we compress this chart, because what we see is that this market has been in a decline and a methodical decline to these lows, and it's just trading off of these lows. And so I don't have some real positive sentiment for platinum. In fact, on a fundamental basis, I'm confused why it is so cheap at $825 per ounce. I'm really satisfied with the performance of gold. I'm extremely satisfied with the performance of palladium. We'll look at that in a second. And then after that, what I really want to do is to take a look at the forecast that we put out at the end of last year, the beginning of this year, and kind of compare it to what we're seeing now, and then talk about the major moves we're looking for over the next couple of years. So platinum, to me, again, I am extremely bearish on it, only because it is one of the few precious metals that is still, well, it's trading just at the 200-day moving average, but it has been under more pressure than any of the other markets per se. And so that is the one that I would really believe has got the least upside potential. And that's what I'm looking at. So one thing that I do want to look at is I want to pull up a chart, and that chart is basically going to be my original forecast, and I'm going to put it in here. This is a static chart, obviously, and I'll wait for it to come up. But this is what we put out back in December 31st, I believe, is when we actually released this. And so what we're looking at, this is a this isn't the minor count, but it's the intermediate count. The one above it, of course, is the major. And we were sitting at that point at about 1,300. And my sense was we were going to see some weakness. 1,300 has been a point almost like the 1,370 has been on a long-term analysis. 1,300 has been an area of congestion. And my sense was that we could see a correction to go either to 23%, which was 1,267, or 38%, which was 1,247. Now, when we compare that to where the market actually moved, we came pretty close. And here's what I find is interesting. My projection for where the market would go on the upside after the shallow correction completed, and it was extremely shallow, but was roughly 1,340. And so we didn't hit it on the mark, but we certainly saw that 1,350, at least for now, has provided some real resistance in the market, and today's move is really signaling a very, very potential correction. And so with that in mind, let's go ahead and go back to our dynamic chart, and this, of course, is going to be our daily. And I want to look at a weekly, because what I found that was super interesting was this last set of candles that came in. Let me go ahead and blow this up. It's a little bit less like a shooting star than it was last night, but this is this week's action. We've got 1 day left. There's the high, there's the open and close, so it's very much a doji candle. The definition of a shooting star would be that the body is, the tail, excuse me, is at least 3 times the size of the body, but typically you want to see the body size a little bit more than this between the range of the open and closing price. And so you would have to label this a doji, but nonetheless, it is a real signal of indecision in the market. And most importantly, what it tells you is that the bulls have been in complete domination of this market ever since this rally began, roughly in August of last year. It runs $150, which is a super rally. As I said, a 2.61% extension. And so it's a very logical place to look for it. And what this signals is the point in time when they're passing the baton from the bulls to the bears. It's that indecision in the market. If we get follow through and lower pricing, that means that the bears now have control. Right now, we do not have any major chart damage. A perfect scenario would be to see the market retrace maybe to the 0.23 or 38 level. I would look at 1308. That would be a very, very nice correction and a perfect entry point for us to re-enter the market. Now, we have a question that came in via email. How important is it if gold breaks 1360 to the 1380 level? Does that mean we have open room to the all-time highs in gold? First of all, we know for a fact that 1370 has been a challenge for gold. We have seen it trade there on multiple occasions. You can see all of these tops here that have come in, and on each occasion unsuccessful. So that is absolutely the record we have to beat. If in fact we get to that point, and my sense is it's not if but when, because I do think we will take that out. We should be able to take it out following this correction. In other words, regardless of how low this market goes, the next major rally up, because we're looking at a third wave, is going to be a fifth wave scenario the fifth wave scenario is going to be approximately $80 to $100 if wave 1 and wave 5 are equal, which is kind of a rule of thumb that we go with. There's two ways to really predict a fifth wave. The first way is wave 1, wave 5 are equal. The second technique that people use is they take a 0.618% retracement of wave 3 and project it as to wave 5, and they both take us over 1370. I think that will take us to 1400. But if that means that we have open room to the all-time highs, that is a signal to me that we're getting there. We're moving in the proper direction. However, we're going to have peaks and valleys before we go to that point, because the most important thing you have to realize about my long-term projection is that I'm looking out anywhere between a year and a half to 2 years, maybe 2.5 years, to get to those levels of 2000, because we're looking at really a major count. And to give you an idea of that, I'm going to need to pull up a long-term study, and let me go ahead and find it, it's right here. And I'll show you what I mean by that. What we're going to pull up it's a static chart once again. This is what we released. Look here, gold's only at 1285. But what we're doing is we're using wave 1 as a benchmark. You use wave 1 to determine where wave 2, 3 goes. 3 you use to determine for 4. And then for a fifth wave, again, you either compare it to wave 1 or to wave 3 as a 0.618% retracement. Now, what you can see is these first red lines here indicate the range of our first wave. And then when we take them and do an extension, it predicted the wave 3, if wave 3 came to a 1.618% extension of wave 1, that would have taken us to 1899, and the market actually went to 1920, so it was right on the mark. In other words, wave 3 was a perfect 1.618 extension. From there, we had a very, very strong retracement, though. Typically, your retracements that you're looking at, the shallow ones are 2.3 or 3.8. The deep ones are 0.618, but this came almost to a 0.78% retracement. Actually, I think it was a 0.70% retracement. And so it was rather deep, which takes us to wave 5. And here's what we're looking at. If we do a one-to-one relationship between wave 1 and wave 5, it takes us just shy of the all-time highs at about 1800. However, when we do the extension, a 618 extension of wave 3, that takes us to approximately 2084, I think, in that area. But in terms of the timeline, as you can see, I'm using a 2-week candlestick chart. It's covering a lot of time starting at 2000, middle of 2001, all the way up to the present. So we're looking at a multi-year cycle in the marketplace itself. And so for that reason, we're on the proper course, so to speak, but that's going to take more time than simply a couple of months to get there. We've got a lot of peaks and valleys in between that. The next thing that I really want to look at is where we think Palladium might go, because that's been probably one of the most fascinating markets that we've looked at, and that took a lot of people by surprise. And so let's go ahead and pull up a weekly Palladium, and you're going to notice a couple of things on this chart. Let me go ahead and mark this down. Really, for me to have predicted anything, I need to do what's called a basic extension. And so on the extension, what I'm looking at is this wave that starts down here at about $460 and goes up to almost $1150. And then I do an extension from this point here. And so what I was looking for is a move between 1500 and a one-to-one is 1567. And I believe that the marketplace has a potential to go there. However, at this point, I think that we should see some sort of a correction. My only fear with Palladium, because I've seen this happen on so many occasions, is Palladium tends to go parabolic to the upside, and when it does, it tends to sell off or correct in a parabolic manner. So for that reason, I would be very, very cautious and look for a pretty sharp sell-off should we actually enter some sort of correction. Of course, we know that this is all dollar-based, but what we've seen recently is even more exceptional. And the reason I say that is because this has been predominantly buyer-based as opposed to dollar strength or weakness in terms of the net changes we are seeing. I believe that the fundamentals that are at play will continue to be at play. We really want to pay close attention to what's going on with the negotiations between China and the United States, because the dollar is propped up so much because of the sense that we could last longer than they could, that once there is a resolution, we could see some strong moves to the downside in the dollar, and that, of course, would be extremely bullish for gold and the other precious metals. Maria asks via email if we could please cover the S&P and our long-term outlook, and certainly can. I just simply need to find that. If you could just give me 1 second. I should have that up here. I have so many charts. This is going to be the E-mini here that we're looking at. And what we can see is this. We're definitely still in a bullish mode. This retracement, which was the most sizable retracement we have, of course, we're looking at a weekly chart, I believe was a 0.38% retracement. We are within 10% of the all-time record highs that come in at around 2,500. I think that we've basically seen the correction end, and we're back into a rally mode. We have some real resistance right based on these tops right here at approximately 2,800, which is precisely where we're at. We're at 2773 right now. So I think that overall, we should see higher pricing in U.S. equities over time. Is there anyone that wanted to take a look at a gold mining stock or any of the other stocks before we move forward? If so, just kind of put a comment in the section, because I have been getting a lot of questions about some of these miner stocks and how much pressure they're under. We can certainly see that with this nugget. Let me find something a little bit better that's more indicative of what we're doing. But pretty much we're seeing the same trend across the board. And that is that the mining stocks and the ETFs representing these are certainly not performing in anywhere near close to what we're seeing in gold. And I get consistent questions as to why is gold performing so well, and yet at the same time these miner stocks are not. And my answer is very simple, and that is with gold we're dealing with just the commodity. A mining stock incorporates how that mine is run, the production costs, the management costs. There are a whole lot of different variables that go into it. And so they're not going to trade like the raw metal itself. However, I am fascinated by how much they haven't moved as gold has moved higher. And I think that we're going to continue to see that trend. Scott B. via email asks, sometimes I receive trade alerts outside of my normal trading hours, and how should I act on those? Realize that when I send out a trade alert, I'm always telling somebody to buy at the market, and I'm looking at entry in terms of a certain zone or placement. And I try to make it during normal trading hours. However, I depend on the actual trigger before I actually implement or send out a trade alert. So sometimes they're at an odd time. If they are, and I send it out at night and you see it 4 hours later in the morning, you can still act on it as a market order. That's the whole idea with our trading system. It's a longer term trend system, and you might get in a couple of dollars better or worse than the initial entry price. But if the trade makes money, you're still going to make money. And if the trade loses money, you're still going to lose money. But I leave a window of hours when I send those out and always say move in at the market. So if you get it at a time that you're not normally trading, look at it a few hours later, you can still act upon it and realize it's just going to change the percentage gain or percentage loss when the trade is done. And hopefully that answers your question. Because to me, the most important thing is getting out timely stops. For example, as we did yesterday, we could have gotten out at the top, but we don't know when that top is. We had some indications that we were getting very top heavy, especially the extension in my initial goal of 1338. And that is why you notice that over the last 2 trading days, I have moved the stop up each and every day because I saw that we were near the top end of our range and there was a high likelihood that we would see some sort of correction or retracement. And so I really attempted to cover that in that way. And so I'm always going to spend as much time on the stop and protecting equity as the initial entry point, because the bottom line is this. We've done very, very well this year. Over the last 10 years, we've done extremely well. But when I say extremely well, it doesn't mean that every trade was a winner. What it means is that we had proper risk reward, and that is that our winners overcompensated for the losing trades. That's the most important thing that I can say, and that the frequency of trades is only about 30 to 35 per year. We're not doing a ton of trades. So the idea is to have good risk reward and to get in a timely way. And I look to capture anywhere between, say, 40 and 60% of a market move. And to me, I'm content with that. And the other thing that's important to understand is I'm not going to get all of the money. I'll leave a lot of money on the table on most trades. But the key is that were we aware when a market's rallying? Are we participating? And if so, were we able to benefit from that? Whether that's 30%, 40, or 50% of the move, the key is being able to participate. So in as much as I try to send out a trade alert at a more normal hour, meaning when it trades in New York, we have a subscriber base that's worldwide. So it's, if I send it out New York time, our subscribers in India and Australia and Europe, it's the opposite for them. So I'm in Hawaii, and the interesting thing here is I'm in the middle of both of those worlds. So I'm kind of monitoring the market all the time. What's most important for you to realize is that I understand that people are going to read it at different times, and it's a window of opportunity rather than an immediate market move that has to be made. Let me see. Gene via email asks, what is my opinion on crude oil? That's an interesting market. I mean, it's been under so much pressure. Let's go ahead and pull it up. We are looking, of course, at our weekly chart. We can see right here on the bottom when this market did bottom out at, what, about 42. We had that perfect doji, and we've got a three-river morning star. I'm going to call it a variation only because the body of the star is inside the body of this green candle, but it's close enough that it's valid, and it is a variation. So we had a strong signal in terms of a bottom. Now, in terms of initial resistance, really we're getting close to it because I'm looking at these bottoms right here, and if we carry them over, that's coming in just a couple of dollars higher than where we are at. And so for that reason, I think we could see some resistance really at the $58 to $60 level and move back lower. But I still think that we are in a overall bearish trend after the sizable sell-off, which is what, $78 down to 42. I've not received any kind of technical confirmation that we have moved from a basic bear market to a bull market here. Rather, I look at this as an upside corrective wave of the most recent sell-off. And the other part of the question is it mainly fundamentally based? And the answer is absolutely. All markets are based on fundamentals. And the reason for me being a technician is not to excuse what happens on a fundamental basis. My original reason that I was so attracted to technical analysis is when I first started in the industry, I would listen to the financial news, and one extremely well-known expert would say that crude oil is going up and it's going to go to 75, and I'd turn the channel and there'd be a well-known analyst saying that it's going down to 50. Both of them made valid points. Both of them had opinions that could actualize, and I was confused. My sense is that although ideas are not etched in stone, mathematics is. And there is a tendency I have seen over time for markets to move in a natural and defined pattern. That's the whole idea behind technical analysis. However, there's one major caveat to technical analysis, and the gentleman that taught me this was one of my mentors. His name is Larry Williams, and he invented the Williams %R. And I was doing extended financial symposium in Europe with him. It was a 1-month tour. We hit 8 different countries, and we were drinking coffee one day, and he said, you know what, being a technician is kind of like sitting at the back of a boat and looking at the wake created from the propellers as that boat moves through the ocean. And the problem with that is, although you can predict where it's been and have a sense of where it's going, only the captain knows when he's going to turn the wheel. And that always stuck with me, because in essence what it's saying is in many instances that those technicals are going to give us a great idea of a normal rhythm of a market, but a shift in fundamental news is going to mean a shift in the way the market trades, and the technical part will not cover that. So I hope that answers your question. And so traders, I want to thank you so very, very much for spending some time with me. We will put this up as a recording for those that weren't able to watch it at this time. But I really enjoyed spending a couple of minutes answering some questions, and I hope that you did also. Really, what I want to say in closing is, it is my wish that these trading techniques that I teach you take you where you want to go, and most importantly, where you go is essentially reaching your financial goals. Again, this has been Gary Wagner, wishing you, as always, good trading, and we'll talk to you tomorrow for a recorded end-of-day market wrap-up. Have a great day. Bye-bye.